Well, for more on risk tolerance, we're joined by Geordie Crossan, certified financial planner and president of NBS Financial Services, joining us from Los Angeles. Geordie, good to see you.
Glad to see you, Ali.
We can't emphasize enough how the risk tolerance idea really needs to govern your decisions, whether you are entirely invested in the stock market, in individual stocks, or in mutual funds, or anything else you do. And yet it does seem to be a step that gets skipped.
Absolutely. And it's important for investors to understand, how much risk they need to take to achieve their objectives. In many cases, they get wrapped up with the day-to-day fluctuations of the market and lose sight of their long-range objectives and what it is they're truly trying to achieve.
Let's talk about that. Once you've figured out what your risk tolerance is, there are many people, Geordie, who say that if you invest according to your risk tolerance, and that means diversify properly, no matter where you are on the scale, old or young, aggressive or conservative, most of the return you gain can be traced back to how well you diversified, more so than whether you got the hot stocks right.
Absolutely, and that's tied to the asset classes or the asset allocation decision. And various studies have shown that the majority of return is tied to the asset classes that one invests in, and not necessarily the individual securities that they select within that specific asset class.
And we roughly break the asset classes down into fixed income and equities, which are stocks. That's roughly, and then cash, if some people keep cash in their portfolio. But within that, there are so many different ways of looking at your investment. So it's not that you should be involved in two things. Maybe you should be involved in 5, 6, or 10 things?
Well, absolutely, because, in the broadest sense, we have equities, we have fixed income, we have cash. But in the equity arena alone, we have multiple sub-asset classes or investment styles of diversification. That could be from large cap, small to mid cap, growth styles, value styles. So there's a multitude of asset classes within that broad category of equities. And investors need to dig deeper and diversify their portfolio accordingly in light of their risk tolerance, in light of their goals and objectives, and truly what it is they're trying to accomplish.
Now, tonight we're going to spend some time talking about small caps because Jim Awad, who is our calling guest, he specializes in that area. And while small caps have done very well, if you study all the different asset classes, some of which you just mentioned a few moments ago, no one asset class has dominated through history. So you may, after watching the show tonight, feel that you don't have small cap exposure, and you should, but we still get calls from people who don't follow a good pie chart way of delineating their investments. They'll say, what do you think of a stock like Countrywide? I've got 60% of my portfolio in it. That's just damaging.
Right, and if investors watch the show and decide that they want to allocate a portion of their assets to small cap, they have to make a commitment. This is not a short-term investment decision, but a long-term asset allocation decision. And where investors tend to get sidetracked is they get swept up with the current market euphoria, make investment decisions based upon that. Usually that's too late, and the market, that segment goes down, and they're stuck holding the bag of a downturn in the marketplace.
Because of the way in which your asset classes will perform one against the other, let's say if stocks are going up, your fixed income portfolio might be decreasing in terms of a percentage of your overall holdings. How often do you rebalance that and make sure that you're back at your back at what you decided your target asset allocation should be?
Well, people need to review their portfolios, I would say, at least quarterly, but annually they need to be looking at rebalancing. And they have to do so with an eye towards the tax ramifications of that decision. And not only rebalancing, but potentially reallocating their assets based upon current market conditions, the economy, interest rates, and so forth. Just as you had mentioned, be it with stocks or bonds and different things going on in the marketplace, investors need to look at that decision and adjust their portfolio accordingly.
Geordie, good to talk to you. Thank you for being with us.
Thank you, Ali. Have a great day.
Geordie Crossan is the certified financial planner, and he's the president of NBS Financial Services, joining us from Los Angeles.